Hey, thanks for tuning in so far. Now let's jump into the final part of our discussion. This is happening broadly too. Like you've seen, you're a global investor. Now, Japan is interesting in the sense where after 30 years, Japanese yields are rising again. The German Bund, the yields are rising. Is this a global sign? What is driving this global rise in yields across the world? Like there was an era of low rates and where it's regime change. What are your thoughts here?
Well, the easy thing is, and I'm curious, like, I'll just have one answer for this. It's like the insane amount of deficit spending, right? If you're an investor, a bond investor, you want a higher compensation for
All
because
this
you're
easy
worried
money
about
that,
inflation. Yeah,
yeah,
exactly.
yeah.
James, I don't know. Do you have?
One other thought, which I'm not in tune enough with the population characteristics of the other like big G7 countries, but I do know that the millennial cohort in the U.S. is a huge cohort. I think it's 70 or 80 million people, sort of born between 1980 and call it 1999. Midpoint of that is 1990. So those people are sort of 35. What do you do when you're 35? You buy a house, you get married, you have a kid, you buy a car and a bunch of furniture. And that is, I think, juicing demand in the economy.
In the real world
In
economy.
the real world
Yeah.
economy. And I'm sure that's playing out in the US and to some extent in Canada. It's probably not a factor in Japan, but there could be pockets of the globe where that's also going on. So it's more of like an underlying cycle that's playing out. And 1990 is sort of the midpoint. We're probably past the midpoint a little bit of the millennial cohort, but like there's probably still a few more years of like upward pressure on economic activity. That's one of the potential theories that I've heard as well.
This fits in line with the industrial supercycle too, right? You need more real world. You need more.
And the other thing too, just we talked to the James was talking about just big demographic shifts, supporting. The other more technical shift is like no central banks doing QE anymore. You've taken a buyer, like, just plainly speaking, you've taken a price,
A massive buyer, price insensitive,
price insensitive buyer out of the marketplace. And if all's left is us, as in I talk about active participants who want to be compensated for their risk, people want higher yields.
Yeah. In some sense, that is also forcing governments to be more disciplined. At some sense,
No, it's not yet, but we can, like, it will.
It will, right?
It will.
You push this to the extreme, and I do. It's so many things going on, and another narrative that seems to have made the round trip, particularly within U.S. equities, and maybe even globally, is the theme of like data centers. In January, February, it was basically DeepSeek has ended the story. And next thing you know, there is a resurgence in U.S. tech, large cap tech, and the narrative again. So what are your big picture thoughts? Is it bounce back from the lows, or has the thesis changed since just a few months back?
I think DeepSeek has democratized the idea that everyone is going to have transformational AI at their fingertips, and it will be transformational. I compare AI to our smartphones, right? And let me just take just a little step back, right? Apple had the smartphone in like 2007. At that point, we were all walking around, James and I, and you had Blackberries, and we thought Blackberries were the coolest. We were the coolest things. And you asked us, why do we like our Blackberries? Because people said, I can send emails. That was
BBMs,
exciting.
yeah.
BBMs and the keyboard.
Yeah.
And Steve Jobs at the time said, I don't think people want to send emails. I think people want to have the access to the internet at their fingertips. And the idea of apps and on your phone that we all take for granted right now, your banking app, your travel app, the app I used to spy on my kids, in the cameras in their rooms, like those weren't even thought of when the iPhone first came out. And now we've built a full program of like the Play Store, the Apple Store, which all these apps, which have completely significantly improved productivity. Why am I telling you this? Is because we're in 2025. 17, 18 years ago, I couldn't have even imagined how transformational the smartphone would be to my daily life, right? As it gets socialized through the system, and I think we're at the nascent infancy stage of AI. And I've been using it now for a few years, and I cannot imagine, I'm being very like humble when I say this, I cannot imagine how transformative it's going to be on our lives and just more in productivity. And I'll end on this, right? Like right now, the most profitable companies in the world are U.S. tech companies. When you look at their free cash flow margins, when you look at their EBITDA margins, etc., the biggest cost item on their on their income statement is salaries, right? Because they're not drilling for oil, they're paying people, right? That's how they produce output. But if you and Jose, you had this great chart. You look at you look at job openings for computer programmers, they're collapsing. Why? Because now you can just ask
The best programmers can do 10x the work in some sense,
exactly,
right?
because you
They're
can
more
just
productive.
because now you have a digital assistant that allows you to write code at a fraction of the cost. So I just like the bullish case is what happens if the most profitable companies on the planet and they're the furthest along in implementing AI in their systems, actually increases the margins and profitability. Like I can easily paint a scenario where you're like, oh my god, like like Meta,
Which is
Meta being
already insanely profitable.
at 50%, EBITDA margins can be even more profitable, and it's growing its top line at double digits. Like the compounding just becomes quite transparent. So I think people are slowly waking up to this idea that AI, yes, there is a huge capex build to get this out there, but there's a full transformational aspect too, and improving margins and productivity and profiles.
Also, it seems the demand may have been underestimated. With all these deals being signed in the Middle East, the true global demand of for chips and for computing seems to have been overly pessimistic in some sense. Any thoughts? James, what are your thoughts here?
So I'm the co-manager of our real estate ETF, global real estate ETF, and one of the biggest real estate companies in the world is in Australia, and it's a company called Goodman Group. It's been a developer for many decades of industrial real estate, and I think it was about 2 years ago they announced that I think it was a third of their backlog is now data centers, and the stock went up a lot. And I just bring that up to highlight that even in some of the infrastructure space that we know well, whether it's some real estate companies that are transitioning to developing data centers or pipeline companies that have had, for the last 5 or 10 years, not a lot of growth, but all of a
But
sudden are
you
seeing
need
huge
demand,
for power
Yeah.
and natural gas to feed the data centers. Like we are seeing the theme play out in different parts of the market, not just semiconductors and the big tech companies. So I think that there's some insight to be gained from how it's showing up in different sectors, and for us it gives us an opportunity to buy some stocks that are somewhat exposed to the theme, but like benefit from contracted cash flows and more
Much more
stable
predictable.
earnings
Yeah.
delivery.
Yeah.
James talked about this, right? It's this is really bullish for Canada too, right? Because we are by definition long energy. We're long energy. We don't, and so if we can export this, like the numbers are, I just off the top of my head, in U.S., like terawatt hours for like the total grid right now is sitting at like 280 or something. Like data center demand just incrementally is expected to move that to between 400 and 600. So you're looking at doubling the demand. Sorry, U.S. data center right now is sitting at 280. We're looking at doubling that in the next few years to between 400 and 600. Let's take the midpoint, 500 terawatt hours. That's the output of France. The energy demand of France, right? Like that's
It's
how much
a country you're adding.
yeah,
in
that's
computing,
a country
yeah.
you're adding in compute energy intensity. So, hey, if our Canadian oil and gas, if our Canadian pipeline companies or Canadian IPPs, independent power producers, can help alleviate some of that, that demand by providing, cheap, renewable, sustainable energy to it, we profit.
A lot of things we've discussed, a lot of things to tie up in some sense. Volatility has been a theme. How have you managed? What are the opportunities that were interesting, big picture thematically? And looking ahead, we're entering some generally lighter summer trading seasons. What is your thought process to approaching the markets for the rest of the year? Yeah.
James, you want to go first? So it gives me time to think.
Sure. I was going to answer that by saying one of the things I think we do really well at TDAM as an equity team is a focus on portfolio construction. And when I took over the TD monthly income fund, you don't want to change something that's worked really well for our clients for a long time, but with an emphasis on portfolio construction, go through the portfolio and just think about the risk hotspots and what opportunities we're maybe not taking full advantage of. And so my headspace coming into the year was, boy, things are uh, really hot. The market is frothy. And so if there were any areas where there's more defensive businesses that seem like they've been forgotten about, we added a few of those to the portfolio. And then as the market sold off, we shifted from bonds to equities a little bit and took on a little bit of risk. Unfortunately, not right at the very bottom. You buy as it goes down because you don't know when it's going to stop. So the headspace has been to take advantage of opportunities, both when things are, too frothy and when things are oversold. And so I sort of will carry forward that mentality over the next 6-12 months. We're optimistic that equity markets are going to continue to climb the wall of worry, but we're watching the policy developments and we'll stay really focused on, what does the portfolio really need so that we can hit our objectives and give clients, what they signed up for.
Yeah, Damian, that's fantastic. Yeah.
Just if I could just summarize what James said, because what he was talking about is the philosophy we have across all our portfolios, and the idea that I keep saying it, right, like keep calm and compound on, is that we here at TD Asset Management, our portfolios that James runs, that I manage along with Ben, it's like high quality compounding. We're not flash in the pan. Our alpha, our outperformance isn't episodic. It's like, just like, hey, let's exploit dislocations when they're there. For example, being aggressive when the VIX is above 60 because it's pricing in 4% up and down moves the next 30 days, which has never happened.
Which is, yeah.
So being, but right now, if if we're talking 6 weeks ago, it said, yes, the market is still unbalanced. People are still on the world is ending side of the boat, and we should take the other side of it. Right now, it feels pretty like there's no exploitable niches in the market that I can see, which means, to James' point, right, we want to be balanced in our exposures. We still want to keep focused on, the quality companies tied to secular growth. We talked about, data center spend. That's still AI. That's still something we're excited about. But overall, you're not getting...
Still balance it out, though.
You're not getting paid to, get out on any ledges. You're really not. You're not getting compensated for that. If I was going to look, I think I agree. I think our quality portfolios in uncertain environments will continue to deliver alpha. But the one thing I want to leave people on, which I'm focused on, is that, we're looking for signs on whether we go from, a little from trend economic growth to, to like much below trend and at risk of recession. Because like what's been the policy platforms being positioned, they could upend the apple cart. I just don't know. So I'm trying to think about looking for actual evidence, not sentiment, hard data that shows that, because like that will require, like if you ask me what we'll do, that'll require us to get more defensive. We're just not seeing it there. But I do want to put it out there in the space that it's not like I think markets are fine and they're but there's no exploitable opportunities right now. There's no real big dislocation. So I think our quality compounding bias in our portfolios that James talked about, being balanced, not taking big risks, will continue to deliver. But we're on the lookout for, for if this could slow.
Yeah, that's the thing. There is an element of uncertainty still at the end of and you have to balance out that risk. And that's generally speaking, what would, just to wrap it up, what would be your blue sky scenario for the rest of the year for equity markets to keep performing?
Have you heard of Trump and tariffs and the term taco?
I heard that recently. Yes.
Right, like Trump always
chickens out.
Trump always chickens out. The
taco tariffs.
Taco tariffs. Look, if tariffs at the, we'll end up with tariffs because they have to be used to pay for some of the extension of tax credits. But if tariffs come to something much more reasonable, like 10-12%, right, and we do have some changes at the margin, and people are focused on reducing, and there are some, like right now the bill's being passed through the Senate. I'm talking about the U.S. here specifically. If we do have some clawbacks in reducing some of the most egregious items and help address the deficit, and then that actually paints a very good scenario for markets. That would be my blue sky, and I think that will actually lift most global equity markets because, by the way, global equity markets have already taken measures. We talked about this. Trump has incentivized change in individual countries. I think if that continues, I think we could be setting ourselves up for, like a really nice run here, right? Like actually improvements in economic growth supported by earnings growth, supported by less tail risks of tariffs. I think that's my blue sky scenario.
And for Canada, James, is
I think that's right. If we can de-escalate the tariff talk and then push forward with infrastructure build out in Canada and deregulation in the U.S., I think that will give us the reasonable, optimistic case for the balance of the year.
now that's a fascinating conversation. Last question, a rapid fire question for James. On the joy of being, and joy and excitement of being a multi-billion PM, which is scarier, having your baby or managing the portfolio?
Having a baby is very scary, and it's been the best experience. I have a daughter that's almost a year old, and
Congrats.
to have that
Yeah.
all happen at the same time, get married, buy a house, have a daughter, take over portfolios. It's been a crazy couple of years for me, and nothing competes with having a human who depends on you screaming in the room next to you. It's not.
While managing a multi-billion-dollar portfolio.
Can I ask a question, a follow-up to James?
Yeah, of course.
James, so how is risk management in portfolios similar to risk management in raising a little child?
I have no idea how to answer that question. None at all.
He's learning as we go. Yeah.
I think that's how we all do it. We
Avoid
just learn as we go.
avoid sharp objects.
Sure. Yeah. Definitely.
Well, gentlemen, thank you so much for the conversation. This has been a pleasure, and looking forward to the next time you're on here as well.
Yeah, so great to be here. Thanks, Jose.
Thanks, Jose. Always great.